Hey, Steve Gaito here, certified financial planner and founder of Retirement Resource Management. I'm sharing today a new PowerPoint presentation that I've put together. Many of you have attended my seminars in the past, and this is a more concise presentation on how taxes can impact several parts of your retirement. So a little bit about me. As you may recall, I've got 28 years experience in the financial services industry. Been a certified financial planner since 2005. I've been known as an educator on retirement planning, long-term care, and healthcare. Actually spent 10 years training both individuals and advisors on Social Security and how to get the most out of it. Been quoted in several national publications like USA Today, Fox Business News, and Money Magazine. But really what I want to focus on today are three goals. First is the federal tax, how you can keep taxation to a minimum. The second is your Social Security benefits, how we can keep those benefits from being taxed so much. And the third part is how to keep your Medicare Part B and D premiums as low as possible. So let's start with what is a tax. You know, a tax by definition is a compulsory financial charge or some other type of levy imposed on a taxpayer by a government organization in order to fund various expenditures. Basically, what it's saying is that we're transferring wealth from households or businesses to a government. So without planning, tax can cost you hundreds of thousands of dollars more in federal tax. It can increase the amount of Social Security benefits that are subject to tax. It can increase your Medicare premiums, and it can devour a chunk of your legacy. So this is a great quote from Ronald Reagan. The problem is not that people are taxed too little. The problem is that government spends too much. To sit back hoping that someday, some way, someone will make things right is to go on feeding the crocodile, hoping he will eat you last. But eat you, he will. And that's a great illustration of what's going on with taxes right now. And as we look at taxes over history, we can see that historically, taxes have been much more high than they are today. We're at some of the lowest tax brackets ever. And it doesn't take a rocket scientist to see, you know, with $30 trillion worth of debt, where that's probably going to go, because the government is not going to spend less. So let's look at the federal income tax. That's levied by the United States Internal Revenue System on the annual earnings of individuals, corporations, trusts, and other legal entities. So when we start looking at taxes, there's a lot of misconceptions out there. Currently, we have a standard deduction that's $12,400. That's going up in 2022. And for a married couple, it's $24,800. What does this mean? It means that your first $12,400 of an individual or the first $24,800 of a married couple is not subject to income tax. But once you go above that, you start running into the marginal brackets. So there's two different things that you need to understand. The tax rates are the rate that you actually pay versus the tax brackets is what you pay on the next dollar you make or earn. So let's look at the single brackets here. So this is just an illustration of the tax brackets and a simple calculation. So over here, we've got the gross income. Let's say you make $100,000. You got your standard deduction of the $12,400. That means that $87,600 is subject to income tax. Okay. And so you've got a base rate of $85,525. Okay. So that base is going to be on the 22% bracket, which is the $14,604. That's the tax that you're going to pay there. And the amount over that basis is going to be subject to 24%. So another $498. That means for a single couple or a single person that the tax is going to be about $15,103. Now, remember, they're in the 24% tax bracket. That's on the last dollar they earn. That's where there's $498. But their effective rate that they're paying is only 15%. Okay. Now let's take a look at a married couple. Same illustration, except that standard deduction is a little bit higher. Okay. So it's $24,800. It means your taxable income is going to be $75,200. That means on the base, that's where you're going to pay right here. You're going to pay $19,000. It means it's going to be subject to that $19,750 or a tax, 10% of that is $1,975. Now, over that 10% bracket, we're getting up to the 22% or the 12%. Okay. And so we're at $55,400. The tax on that winds up being a total tax of $8,629. So even though for a married couple making 100, it looks like they're in the 12% tax bracket, they're really only paying 8.62%. That's an important concept to understand, because when we start looking at how we deal with where we take money, all these different rules come into play. And so here's an illustration of a couple. They got a pension of about $12,000. They got Social Security benefits of $38,000. They take about $50,000 out of their IRA or their 401k for an income of $100,000 or $833 a month, $8,333. So when we look over here, the tax calculation, 12 plus the 32 plus the 50 gives you a gross income, $94,293. You take out the standard deduction. You see how much is subject to that 15% tax. You know, after tax income, you know, it's $89,576. There's your taxable income. So it's changed from the 833 to 74. The difference right here is the amount of taxes that you're having to pay on. And that's an important part, because the more I talk to people about their IRAs or their 401ks, they don't realize that they have a partner in it and that the government is going to get their fair share. And so we want to look at that. Now let's take a different look at this. What if that money was in a Roth IRA? Okay, so same income, still getting that $100,000, but now that $12,000 worth of pension is subject to income tax. The Roth is not subject to income tax because it comes out income tax free. And because of what's known as a provisional income calculation, their Social Security is not going to be subject to taxes. So their gross income is $12,000. They get their standard deduction. There's no taxes. And so they're still getting the $100,000 or the $833, but it's not reduced by taxes. This is why I think it's important that people understand how and when they take money out of their accounts makes a big difference. And the more that we can get over to, especially later on in retirement, where it's not subject to income tax, the better off you're going to be. So let's look at this again. When I'm looking at these withdrawals out of here, you know, there's a Social Security and the Roth not subject to taxes, zero difference there. All right. So now let's talk about adjusted gross income. That's calculated by adding together all the qualified income and subtracting all qualified deductions. It's in the taxpayer's best interest to get their adjusted gross income as low as possible. Lower AGI qualifies the taxpayer for more tax benefits and ultimately results in a smaller tax bill. So provisional income is what the IRS uses to determine how much of your Social Security benefit is going to be subject to income tax. And so basically, provisional income is your adjusted gross income. That's your pensions, your IRAs, your 401k withdrawals, plus tax-free interest, which may be municipal bond, plus half of your Social Security benefits. That's how you calculate your provisional income. And then, depending upon where you are in that, if you're married, I'm just going to focus on a married couple. If it's below $32,000, none of that benefit is subject to income tax. If it's between 32 and 44, half of your Social Security is going to be subject to income tax. And then if it's above 44,000, 85% of it is. So that's how we were able to get the provisional income to a level where they were not having to pay taxes on their Social Security benefit. Okay, so here it is again, the taxable Social Security, using those calculations right there, $23,850. That's below the 32, so they're paying zero taxes on their Social Security benefit. So, and there it is illustrating it. You take the lowest of those three calculations. So let's talk now about Medicare Part B and D. Why is it important to keep those premiums? Well, so higher, if your income goes up higher, then you're going to pay higher Medicare Part B and D premiums. This really affects people with higher incomes, and it can affect people with large 401k and IRA balances, simply because they've got to take those required minimum distributions, and it can kick them into the next level of the calculations. Now, unlike the Social Security benefit, this uses modified adjusted gross income, which is a little bit more complex, and it's looking 2 years back. So, I'm not going to go deep on this. It's something I will work with your CPA, or I can do the calculations myself. But really, you just need to know that it uses modified adjusted gross income instead of adjusted gross income. All right. And there it's talking about the difference. It disallows some certain deductions and credits. So when we start looking at Medicare Part B premiums, it's based on your modified adjusted gross income. So for a lot of people, if it's $174,000 for a married couple, they're going to pay that $144,000. That's going up this next year. But you can see as your income goes up, so does that premium. And so you want to make sure that you keep your modified adjusted gross income as low as possible. Same thing is true for your drug part. If it's below 174, there's no cost for it, and it goes up from there. So what affects what? So taxable income affects your federal and state taxes. Adjusted income, gross income, affects your Social Security benefits. And modified adjusted gross income increases the Medicare Part B and D premiums. So lowering your taxable income can make a significant difference in how much taxes you pay and how much you pay on your Medicare. So how do you lower how do you lower your taxable income? Now, the first thing you want to do is fund your retirement accounts with a strategy in mind. A lot of people do a great job of savings, but they have no idea how they're going to take it out, what impact that's going to have. They need to know which accounts to pull from. And so, if you've got a mix of tax-free accounts and taxable accounts, it behooves you to figure out how to create a blend between the two so that your modified adjusted gross income and your adjusted gross income don't change the cost of some of those other benefits. You need to know which resources and what options you have, and then work with someone like myself to create that plan. That's really the benefit that you need to have. So how do you create tax-free income? This is a question I get in almost every seminar. Roth conversions, which are withdrawals from a Roth IRA, are considered tax-free income. And that's why I'm a big proponent. I've got a flat fee for doing Roth conversions for folks, because I think it is one of the most beneficial things that you can do. Whether you do a little or you do a lot, it just gives you options to control how much of your income is going to be subject to income tax. Now, max or overfunded life insurance policies is something that is becoming very popular right now. It allows you to withdraw the maximum funded life insurance policies because you're borrowing from yourself. And this creates income tax-free income. And this is because you were borrowing from yourself. And it works very well. It's been done for a long time. And it, if done properly, can make a significant difference in the income you have. And the last thing is home equity conversion mortgages. These are frequently known as reverse mortgages. Not always a first choice, but there are some important things that you can do here that can make you or allow you to have tax-free income. And the other thing is, if you still have an existing mortgage, it's a great way to eliminate that and free up some money in for your budget and your cash flow. So a Roth conversion is the moving of assets from an IRA to a Roth. Once the taxable amount that's converted is added to your ordinary taxable income for that year, and it can help you lower the amount of your qualified funds in a 401k, 403b, 457 IRA, and other taxable accounts. But once you've paid that tax, it's done. And so the question I get is, well, I'm leaving money from a big account and it's going into a smaller account. Isn't that going to affect me? Well, mathematically, the answer is no. As long as the taxes stay the same, it really doesn't matter whether you pay the taxes now or you pay it later. But why this is an important part of a strategy and a tax efficient strategy is it diversifies you from taxes. I have no idea what the government's going to do. I believe that taxes are going to go up. And if taxes go up, then Roth conversions are going to be a great option. They will be a great decision that you make. If taxes stay the same, well, then it doesn't impact you at all. And if taxes do go lower, in full disclosure, then it will have been a mistake. But you can leave it in that account growing and leave it to your kids, and they get the money income tax free. And so having the option, having some that's in qualified accounts that you can use for things like charitable contributions once you're over 70 and a half, whether they're money that you draw to keep yourself up to the top of a tax bracket from there, and then you take other withdrawals from the Roth to keep your Medicare and your Social Security benefits as efficient as possible. Those are all reasons that you would use a Roth conversion. So let's move on to the max funded tax advantage life insurance contract. This is part of the IRS code. It's 7702. It allows you to do this. But if done properly, it can be an inexpensive way of creating tax-free income. And it also gives you some liquidity because you can borrow from it. The other thing that's nice is that these products, in most cases, I'm talking about Index Universal Life, were created for retirement. And so not only do they address tax-free income, they address long-term care issues, and it also provides an estate benefit. So there are three things that you get with it. So if your goal is that you want to fund long-term care and also some estate benefits, you probably should consider the max funded life insurance instead of the Roth. But there are a lot of factors that go into it. We'll discuss all those things as we meet. So how does that really work? So, let's look at this. Oh, sorry, let me change right back. The cost of insurance is $300 a year. You put in extra money, and that's another $24. Your total premium is $6,000. Now, after 10 years, you've got cash value of $24,000, and at 5% growth, you actually have tax-free funds of about 31, almost 32,000. And that's an important thing to consider when you start looking at using the life insurance. How does it do? An illustration is created. I can show you that, show you the benefits of it. So the HECM, as they're called, home equity conversion mortgage, is a type of FHA insured reverse mortgages. It allows seniors to convert the equity in their home to cash, and that amount can be borrowed based on the appraised value of the home and the age of the borrower, and the amounts borrowed from the HECM are considered tax-free. Now, I think this is an expensive way of doing things. I'm always looking for ways to do it. But a lot of times, if people are having trouble with their budget or they're going to run out of money, by simply doing something like this that eliminates a mortgage sooner than later, it may make sense to do it. Again, it's one of those things that I can model in my plans. And so the more ways that we can create tax-free options for you for income, the better you're going to have and the more choices you're going to have. So let's look at legacy and estate tax. What would you like to leave and how do you want to set it up? So the first question is, do you have a will? Have you set it up? When was it last updated? Do you have a trust, and is it really necessary? I know with the Secure Act changing, a lot of these trusts are not necessary anymore. You may want to consult your attorney about that. Have you divided your assets among the heirs or beneficiaries? So depending upon the person and depending upon their needs, it may make sense to set up separate IRAs or Roth IRAs for them that will benefit them. Have you had a conversation? Who's going to be your executor or executrix? Have you chosen durable and healthcare powers of attorneys? And do you have funds set aside to pay for funeral expenses? One of the benefits of a prepaid funeral is that it allows your beneficiaries, the ones that are remaining, to not have to deal with those details in a very difficult time. I'm a big proponent of doing that. So this was an interesting statistic. This came from Northwestern Mutual. It said 9 out of 10 Americans say nothing makes them happier, more confident than feeling like their finances are in order. And so one of the things that I try to do is help people get them in order. We'll start by gathering the information. We'll categorize it. And by doing that, it can help me actually figure out where's the best place to take the money in the most efficient way. Now, once we've done that, we'll look at how much of your portfolio is at risk, how much is at a low risk, how much is qualified, how much is non-qualified, how much you've got subject to income taxes. All those things we'll consider. And then we're going to create a baseline. And for some folks, I mean, majority of folks actually, there will be an age where they will run out of money, mostly because they haven't considered the impact that taxes have. And then especially now with people having to live on 401ks and stuff like that, having that cash flow come out of those funds means that that money's at risk. And so when we have a 2008 or something like that, 2000 to 2003, those types of situations can have significant impact on your retirement assets. So by creating cash flow that's more positive, that's another way to help. And so if you look at the one before, so right here, you're looking at $4,000 a month, and now you're looking at $1,500. Well, if I've only got to take $1,500 a month out, I've got less that is at risk of market fluctuation. The other thing that happens by creating an income stream here is that you have your money will last longer. And that's again because you have to put less stress on those assets that are over there. And so I look at those types of things to make sure that you've got a viable plan. And that's the bottom line. No two people are the same. And so figuring out how to do it is really a challenge, and that's what I do. So one of the things I want to be able to offer to you, the first is an easy to understand analysis that's specific to your situation. I'll create that base plan and be able to look at some different options. Doing this for a long time is pretty easy for me to do. I'll address a lot of your financial concerns that are out there. I'll give you answers to important questions that you have. And then finally, I'll provide you a sound strategy now and for the future on how you can improve some of the things that are on there. Then most importantly, we're going to sit down at least once a year and make sure you're on track. Nobody has a crystal ball. I'm all about diversification. I'm about investment diversification. I'm about tax diversification, and I'm about income diversification. So having those three things together need to be reviewed on a regular basis. So we want to do that. So in review, I really focus on the federal taxes. Let's figure out ways that we can keep taxation to a minimum. Let's get you the most benefit from your Social Security and see if there isn't a way to get some of it less taxable. And then keep your Medicare Part B and D premiums as low as possible. So I offer everybody 1 hour of time free of charge. Come into my office, sit down. We'll talk about all these things. I'll create your base plan for you. I've got a real simple to complete form. It's an onboarding form that allows you to gather all your data that I'll need to be able to do it. And once we have all that information, we can create the what ifs and see what's really beneficial, because a lot of times people say stuff, but it may not be true. And so by being able to model them and show you what the impact of certain strategies are, it will tell us which is the best way to go. So if you want to contact me, my website, it's got an online scheduling program there, retirerm.com. My phone number from my main office is 828-559-0299. You can reach out to me personally at email, steve@retirerm, or my assistant, Morgan Wiley, at retirerm.com. Also, check me out on social media. I put stuff up on Facebook, on Twitter, and LinkedIn quite frequently. If you'd like to make an appointment, please feel free to give me a call in my office. Love to be able to help you. So, my specialty is saving taxes in retirement. I will work real hard to help you lower your federal taxes, increase your Social Security benefits, and reduce those Medicare premiums. Let me help you. I'd love to do it. Thanks, and look forward to talking to you soon.